The first punch in this story isn't a confession, a courtroom, or even a headline. It's a number, $65 billion, vanishing into thin air with the elegance of a magic trick and the brutality of a financial execution. One December morning, the world learned that this mountain of wealth, this towering monument of consistent returns, had never truly existed. It wasn't invested. It wasn't traded. It wasn't growing. It was vapor, wearing a three-piece suit. To understand the shock, imagine waking up to discover that an entire nation, the economic size of a small country, had been erased overnight. Not lost to war, not destroyed by disaster, but revealed as pure fiction. The illusion had been so grand, so meticulously staged, that thousands of investors believed they were sitting on fortunes that could outlive them, endow universities, build hospitals, and fund retirements for generations. Instead, they had been holding shadows, mistaking them for gold. Wall Street didn't roar when the truth surfaced. It staggered. Banks scrambled to count their exposure. Hedge funds reviewed statements with the queasy realization that the numbers were too perfect, and families stood frozen in their kitchens, staring at account balances that had transformed from 8 digits to 0. Somewhere between disbelief and rage, the world confronted a chilling fact. This wasn't a simple fraud. It was a structural collapse, a financial black hole so powerful it swallowed decades of trust in a single gulp. And the cruel irony? The scheme didn't implode because someone uncovered it. It imploded because it ran out of imaginary space to hide in. Proof that even the biggest lies eventually suffocate under their own size. Long before the collapse, the $65 billion illusion stood on foundations that looked solid enough to build a skyscraper on. It wasn't charisma or charm that made the scheme possible. It was architecture. A clean, elegant, almost mathematical structure designed to make even the most skeptical investor lean back and think, everything checks out. The brilliance of the scheme wasn't in its complexity, but in how deceptively simple the foundation appeared. It began with an image, a firm that looked boring in all the right ways. No wild volatility, no flamboyant trading strategies, no high-octane promises, just calm, steady, perfectly reasonable returns. The facade was crafted like a luxury storefront, modest enough to feel safe, exclusive enough to feel desirable. Elite investors weren't drawn in by fireworks. They were seduced by the soft glow of stability. Behind that facade was a careful dual structure. On one level, there was the legitimate business, the well-lit trading floor, the hum of computers, the visible, respectable side that visitors admired. On another level, there was the sealed-off operation where the numbers were manufactured, where the illusion was fed and watered like a prized plant. 2 layers, 2 stories, one for the world to see, one for the scheme to live in. The psychological foundation was even stronger. Investors crave stability, like desert travelers crave water, and the financial world of the late 20th and early 21st century was full of storms, market crashes, tech bubbles, geopolitical shocks. In a landscape where everything shook, the promise of consistency was intoxicating. The illusion didn't require wild profits, only the soothing, rhythmic heartbeat of moderate returns that never dipped, never spiked, never behaved like reality. It was the financial equivalent of a lullaby. The brilliance was that it didn't look like brilliance. The returns weren't spectacular. They were believable. They blended into the background of financial noise so smoothly that people forgot to question them. And because the returns were steady, investors told themselves they were being responsible, not greedy. They weren't chasing insane gains. They were embracing discipline. That self-congratulation created a protective shell around the scheme, insulating it from suspicion. The crowd psychology was the final pillar. Money attracts money, and nothing spreads faster than a whisper that this fund never disappoints. Soon the illusion fed on reputation alone. Investors lined up because other investors had lined up, each believing the wisdom of the crowd was safer than the wisdom of caution. The foundations of the fraud weren't built on genius. They were built on a deep understanding of human desire. The desire for calm in chaos, certainty in uncertainty, and wealth that grows quietly without asking too many questions. At the heart of the $65 billion illusion was a machine. A quiet, humming engine hidden behind locked doors and frosted glass. It didn't trade stocks. It didn't analyze markets. It didn't predict anything. What it did, with ruthless efficiency, was manufacture belief. And belief, when polished enough, can look indistinguishable from profit. The mechanics were deceptively straightforward. Money flowed in from new investors, hungry for the steady, comforting returns they had heard whispered in country clubs and boardrooms. That fresh cash was immediately rerouted to satisfy withdrawal requests from earlier investors. No trades, no strategies, no brilliant timing. Just a continuous recycling of funds dressed up as performance. It was the financial equivalent of filling a swimming pool using buckets of water stolen from the deep end. But the true craftsmanship was in the paperwork. The statements weren't sloppy fabrications. They were immaculate. Every fake trade was precisely time-stamped. Every non-existent stock position was balanced with the grace of a seasoned accountant. The numbers lined up so neatly, you could almost hear them whisper, "Relax, everything is under control." Investors received monthly snapshots of portfolios that behaved less like real investments and more like obedient pets, always growing, never biting. This illusion required a headquarters, and that was the infamous 17th floor, an isolated zone where reality went to die. Computers there weren't connected to the real trading system. They functioned like typewriters for fantasy finance, printing out perfectly formatted trade confirmations for deals that never happened. A small team processed these phantom transactions, entering numbers that would eventually travel to thousands of homes, convincing thousands of people that their wealth was flourishing. The flow of money itself had its own choreography. When investors asked for returns, their funds were sent promptly, reinforcing the idea that the system worked flawlessly. New investors didn't just replace the money going out. They expanded the illusion, inflating the pool of supposedly growing assets. As long as money kept arriving, the engine kept purring, and it purred for decades. The genius wasn't in hiding the fraud. It was in normalizing it. Investors didn't see miracles. They saw routine. They weren't dazzled by huge surges. They were lulled by modest gains. The machine survived because it didn't try to be spectacular. It tried to be believable. And in finance, believability is a far more powerful disguise than brilliance. The $65 billion number didn't represent real assets. It represented the cumulative weight of imaginary profits compounded year after year. Every fake statement added another layer to the illusion until the scheme grew so gigantic that even seasoned professionals accepted it as part of the financial landscape. A Ponzi scheme shouldn't have been able to reach that scale, but this one did. Because its engine wasn't built to amaze. It was built to reassure, to comfort, to whisper the one sentence every investor longs to hear. Your money is safe. The journey from a modest illusion to a $65 billion financial behemoth wasn't an accident of fate. It was the predictable result of momentum, reputation, and a market ecosystem that practically fertilized the fraud. Once the machinery was running, the scheme didn't just grow, it inflated like a balloon connected to an air compressor no one bothered to unplug. The first accelerant was institutional money. Early on, wealthy individuals fueled the engine, but as whispers of perfect stability spread, hedge funds and feeder funds entered the scene like high-pressure hoses pouring gasoline onto a controlled flame. These intermediaries didn't invest millions. They invested billions, raising money from their clients and funneling it straight into the illusion. Suddenly, the Ponzi machine had a booster rocket strapped to its back. Then came the charities, the foundations, the pension funds. Each category added a different kind of legitimacy. When a prestigious nonprofit or international bank placed funds into the strategy, outsiders saw it as validation. If they trust it, it must be real. Reputation morphed into insulation. Every new major investor didn't just add capital. They added credibility, a protective shell that made questioning the system feel almost foolish. The scale ballooned because the scheme fed on network effects. When one billionaire invested, his friends followed. When one hedge fund bought in, competing funds feared being left behind. It became financially and psychologically risky not to participate. The illusion gathered weight not through secrecy, but through ubiquity. A fraud so widely accepted begins to camouflage itself as normal. But rapid growth came with exponentially increasing fragility. A Ponzi scheme is like a skyscraper built on a trampoline. The higher it gets, the more violently it wobbles. As paper balances swelled, the cash required to satisfy future withdrawals grew with them. The larger the fraud became, the more dependent it became on an endless conveyor belt of new money. What looked like stability was actually a structure under tension so extreme that any pause, even a brief one, could snap the entire system in half. Warnings did exist, but they were smothered under the weight of collective denial. Banks noticed strange reporting discrepancies, but shrugged because the returns were too predictable to challenge. Auditors should have asked why billions in supposed trades never appeared in clearing records, but the chosen auditing firm was so tiny, it practically guaranteed no one would look too deeply. Regulators received mathematical red flags from independent analysts, yet filed them away like unimportant paperwork. Why? Because acknowledging a problem would have meant confronting a terrifying possibility. That one of the biggest, safest-looking pillars in the market was actually hollow. And if that pillar fell, the shockwaves would rattle institutions worldwide. So everyone, banks, regulators, investors, subconsciously agreed to maintain the illusion. That tacit agreement was the real fuel source. It allowed the scheme to grow to impossible size, to evolve into an ecosystem of its own, to shape the behaviors of markets and investors without anyone realizing they were orbiting around a void. In the end, the fraud didn't reach $65 billion because it was brilliantly designed. It reached $65 billion because the world kept feeding it, praising it, defending it, and because nothing grows faster than a lie people want to believe. The collapse didn't begin with a confession or a slip-up. It began with a world running out of cash. In 2008, the global financial system convulsed so violently that even the safest institutions scrambled for liquidity. Investors weren't looking for profits anymore. They were looking for survival. And survival meant withdrawing money wherever it could be found, including from the seemingly invincible $65 billion fortress of steady returns. Here is the brutal physics of a Ponzi scheme. It lives as long as new money outruns old promises. The moment that flow reverses, the engine seizes. And 2008 wasn't a slowdown. It was a full-stop collision. Billions of dollars in redemption requests hit the scheme like a tidal wave slamming into a sandcastle. For the first time in decades, the inflow trickled, then thinned, then evaporated entirely. Inside the structure, the numbers stopped adding up. Withdrawals weren't returns anymore. They were a drain with no refill. The liabilities embedded in fake statements had swollen to impossible heights. When investors asked for cash, they weren't asking for profits. They were asking for money that had never actually been invested, never grown, never existed. The demand was real. The assets were imaginary. There was no mathematical path to survival. The timing of the collapse became unavoidable. Markets spiraled downward, wiping out wealth globally. Hedge funds faced margin calls and rushed to pull funds from anywhere they thought money still sat. That sudden, desperate stampede exposed exactly what the scheme had been hiding for years: liquidity, so thin it might as well have been smoke. Even returning a fraction of the requested withdrawals would have required a miracle. In a normal fund, liquidation means selling securities. In this one, liquidation meant admitting there were no securities to sell, only fabricated positions printed on polished statements. The chain reaction was swift and merciless. Redemption requests soared. Cash reserves dried to dust. The internal accounting vortex spiraled out of control. And the structure, once an elegant, soothing illusion, began to crack like ice under too much weight. By early December, the fraud was no longer failing privately. It was financially dead, a machine that had run out of fuel, excuses, and time. The scheme didn't collapse because someone uncovered it. It collapsed because the global panic starved it to death. When the music stopped, there were no chairs left, no assets, no cushions, only billions in promises that could never be honored. And in that moment, the $65 billion illusion finally snapped, revealing itself for what it had always been: a towering financial monument built on nothing but paper, trust, and hope, all three of which disintegrated the second the cash flow dried up. When the dust settled, the numbers finally came into focus. And they were uglier than anything imagined in the chaotic first hours of the collapse. The world had heard $65 billion lost, but that figure wasn't cash. It was the total of fictional profits printed on statements, layered over years like coats of glossy paint, hiding rotting wood. The real money, the dollars actually invested, was closer to 17 to 20 billion, still enormous, still catastrophic. But the gap between real losses and imaginary gains revealed just how deeply the illusion had invaded the financial bloodstream. The fallout wasn't a single explosion. It was a chain detonation across sectors, borders, and balance sheets. Feeder funds that had shoveled billions into the scheme went belly up, dragging their clients into the abyss with them. Pension funds, guardians of retirements for teachers, firefighters, and nurses, discovered their conservative allocations had evaporated. Charities faced existential crises. Scholarships vanished. Research grants dissolved. Entire programs collapsed overnight. The economic damage didn't stay contained. It rippled through communities like shockwaves through glass. International banks scrambled to explain how they had funneled client money into the fraud without performing basic verification. Some institutions took billion-dollar write-downs. Others tried to sue their way out of responsibility, pointing fingers at auditors, regulators, and even the victims themselves. The courtroom became a battlefield of competing claims, desperate arguments, and frantic attempts to recover scraps from a collapsed financial carcass. Enter the liquidation process, a slow, relentless excavation led by court-appointed trustee Irving Picard. His mission wasn't heroic, it was surgical. He tracked money across continents, froze accounts, sued feeder funds, and clawed back billions from anyone who had withdrawn more than they originally invested. It was messy, contentious, and controversial. Some investors who thought they had played it safe suddenly found themselves on the hook to return funds they believed were legitimately theirs. The logic was harsh, but unarguable. If your profits were imaginary, then your withdrawals were someone else's principle. Over time, Picard recovered more than anyone thought possible. Tens of billions, a record for financial fraud recovery. Yet even with those successes, the damage remained profound. Many victims saw only partial restitution. Others received nothing at all. Markets, too, absorbed a heavy invisible cost. Shattered confidence. Investors questioned auditing processes, risk models, and the very idea of due diligence. If a fraud of this magnitude could grow undetected for decades, what else lay beneath the surface? The economic scars didn't fade quickly. They lingered in frozen projects, empty endowments, and retirees forced back into the workforce. The scheme had not simply stolen money. It had destabilized financial ecosystems that depended on that money to survive. And the cruelest truth of all was this: the losses weren't just measured in dollars, but in trust, opportunity, and time. three currencies far harder to recover than cash. In the long shadow of the collapse, the $65 billion scheme left behind a legacy far larger than the fraud itself. A legacy built on shattered faith, rewritten regulations, and the uncomfortable realization that the financial world is far more fragile than anyone wants to admit. Long after the lawsuits ended and the headlines faded, the deeper questions remained like smoke trapped in the rafters. How did this happen? How did it grow so large? And what exactly does it say about the system that allowed it to thrive? The aftermath forced regulators to finally look in the mirror. Oversight was tightened, auditing standards grew sharper. Funds faced new transparency rules, custody requirements, and verification obligations that had been inexplicably optional before. The SEC rewrote playbooks, revamped procedures, and publicly promised never to miss a red flag so obvious again. But beneath the new systems and controls, a quiet, uneasy truth persisted. Rules can be rewritten, but human psychology cannot. Because the real engine of the $65 billion fraud wasn't a clever mechanism, it was belief. The belief that steady returns exist in a chaotic market. The belief that prestigious clients must have done their homework. The belief that a reputable name signals safety. These weren't financial failures, they were cognitive ones. A fraud of this magnitude doesn't rise by defying the system. It rises by aligning perfectly with the fantasies the system wants to believe. And this is the legacy investors still wrestle with. The recognition that markets don't just reward intelligence, they reward vigilance, skepticism, and the willingness to question comfort. The scheme exposed how easily brilliance can be faked, how quickly crowds can turn illusions into institutions, and how little it takes for stability to be nothing more than a beautifully maintained lie. In the years that followed, new scandals emerged. Different names, different mechanics, different disguises, crypto bubbles, algorithmic blowups, corporate manipulations dressed in Silicon Valley charm. Each carried echoes of the same lesson, the $65 billion scheme carved into financial history. Fraud evolves, markets forget, and greed never retires. Its legacy isn't just a warning, it's a reminder, a permanent footnote at the bottom of every glossy investment pitch, that the next great financial disaster won't arrive looking suspicious. It will look safe, predictable, and impeccably reasonable. It will look exactly like what people want most: